Hello everyone, and welcome. Today, we're going to explore how to use the DMAIC framework, yes, the core methodology of Six Sigma, in algorithmic trading. If you're aiming for consistent results, this is a framework you need to understand, because in trading, success isn't about finding the perfect entry. It's about controlling the variability of your process. As I always say, in trading, those who manage variability win, not those who chase flawless entries. Now, algorithmic trading offers huge opportunities, but it also comes with pitfalls. Many traders produce equity curves that look great on historical data, only to see strategies fail alive. Why? Common mistakes include overfitting to historical data, ignoring transaction costs like spreads and slippage, inconsistent risk management, chasing patterns in random noise, emotional tweaking of the algorithm, or even overlooking basic data quality and system integrity. To avoid these pitfalls, we need to treat strategy development like a continuous improvement process. This is where DMAIC comes in. DMAIC stands for Define, Measure, Analyze, Improve, and Control. Originally from Industrial Six Sigma, it's designed to improve processes by focusing on real causes of problems. In trading, we treat the strategy as a process. Its outputs, profit, drawdowns, number of successful trades, can be measured, analyzed, and optimized. Every decision is guided by data, not intuition. Let's start with Define. This is where we clearly state what we want our strategy to achieve. For example, a goal might be a 15% annual return, a maximum drawdown of 10%, and a defined risk-reward ratio. We identify CTQ, or critical to quality, factors. These are key elements that determine success: which markets to trade, the time frame, the type of entry signals, and risk management rules. Tools like Minitab can help us visualize possible causes of failure using a fishbone diagram. We also establish our hypotheses, for instance, assuming that a moving average crossover captures trends, or that the strategy works on a currency pair with a certain volatility. Finally, we define the project scope, like which market and period we will analyze. Next comes Measure. Here, we collect and inspect historical data. Are the data complete? Are there gaps or extreme outliers? We measure market characteristics, volatility, average price changes, autocorrelation of returns, and examine distributions using Minitab histograms and box plots. A box-Cox transformation might be applied to normalize data. Basic statistics, mean, median, variance, help us understand the behavior of returns. These insights directly inform the strategy design. For instance, if returns show strong left skew, we might adjust risk management to handle larger potential losses. The third phase is Analyze. Now we test our hypotheses and identify real patterns. We check correlations between indicators and future prices, run regression analyses, and use ANOVA or non-parametric tests like Mann-Whitney or Kruskal-Wallis in Minitab. We also test stationarity to ensure market behavior is consistent. This stage separates genuine signals from random noise. Perhaps our moving average entries work well only under certain conditions, or only on a specific time frame. This knowledge guides optimization. After analysis comes Improve. Here we refine and optimize the strategy. Using StrategyQuant X's builder, we adjust moving average lengths, stop-loss levels, and entry filters. In Minitab, we can use a design of experiments to systematically test parameter variations and Pareto charts to see which changes impact performance most. After filtering for minimum trades, profit factor, and maximum drawdown, we apply robustness tests, out-of-sample evaluation, Monte Carlo simulations, walk-forward matrix analysis, and parameter permutations. The goal is to reduce variability while maintaining consistent performance. Finally, control. Once live, we monitor the strategy in real time. Key metrics like equity curve, number of trades, and profitability are tracked. Control charts, such as XBAR or EWMA, visualize stability, while drift metrics track changes in volatility or parameters over time. We perform monthly and quarterly reviews, repeating DMAIC cycles to adapt to market changes. This ensures the strategy remains robust and aligned with the original design goals. Let me give you a concrete example. Imagine a simple trend-following strategy on EUR USD with a 5200s moving average crossover on the H1 chart. The target? Roughly 15% annual return. Max drawdown 12%. Historical data from 2015 to 2020 showed daily volatility around 80 pips, slight positive skew, and weak autocorrelation. Regression analyses confirmed the strategy underperforms in low volatility periods, so we optimized for higher volatility windows. Using StrategyQuant X, we built 120 filtered strategies, all passing walk-forward and Monte Carlo robustness tests, with an average profit factor of 1.7 plus or minus 0.2. Deployed live with 1% risk per trade, the strategy stayed within expected drawdowns and returns, and quarterly DMAIC reviews kept it aligned with market conditions. In short, DMAIC gives you a process-driven approach. Define goals, measure results, analyze patterns, improve methods, and control execution. It reduces risk, builds confidence, and ensures that strategies are robust, not just backtest perfect. Remember, success in trading is a marathon, not a sprint. By following DMAIC, your strategies evolve gradually into resilient, data-backed systems ready for real market conditions.